500 and almost 600 pips. So about 200 more pips from the front to the end. So the question, I guess channels are really used to find out where you're at in the price movement. So if I was to draw another part of this, so even if the channel just moves between here, I can look at this channel and say, well, where's price moving from here? And so basically it just came off the level of demand, and so price is moving up. Bull's in control. So at some point right around this area here, price should touch the upper end of this channel here up with this high based off this trend line here. So we have two places where it can move based off of historical movement here within this area here, or within the secondary area here, right? So the question is, I guess, which one is more valid? You know, price right now is moving between this trend line here and this trend line, whereas before it was moving from here to here.
Okay, so what are you trying to achieve with the aid of a channel?
I'm trying to isolate where price is moving without violating the upper or lower lines. Because if I can determine where price is moving within this channel, then it's easy for me to trade, right? Because I know that if I'm here, I know where I'm at in the channel. It's in the level of demand. I go long up until about this area, right? And then once price is close to here, I'm not saying that's going to exactly hit here because it could test this or whatever, but I know that sooner or later that if this is valid, if this is a valid line, then I know to go short when it gets up into this area and then come back down. So I guess to answer your question, I'm trying to validate where price is going to move to from point E to point B. So this being point A here to point B up here.
Okay, to go to point B, will you have the patience enough to wait until the price gets there, though, without micromanaging the account? That's the question.
Yeah, absolutely. It's not a problem at all, actually.
So what if it reaches on a level of an equilibrium and it starts to drop, and then out of nowhere the profitability decreases? Now we're still in a profit, but it's currently decreasing. Will the trader then start to micromanage the account, or still dictating, though, like knowing when to exit, when it's really time to exit? Okay. All right, no problem. So those are the main things that I guess the main reason why you're asking is simply how can I determine where the price is going to be. Okay, that's no problem. All right, let's go through about highs and the lows. So you determine the highs, you determine the lows of the trend. What do you think are the midpoints? What do you call them?
Well, the midpoints would be the equilibrium, and it did exactly what you just said. I mean, here, you know, it stabilized itself here, and then took a bearish run down to the downside, came back and did the same thing again, but ultimately did test this level again, which is where I drew the line. No guarantees that's going to touch that again. But I guess the reason why I'm asking this question is the ultimate area to collect profits. So if I go in here, I can easily say, well, I'm going to collect profits and be out of the trade right here. But there's all this movement up here that it could potentially go to. And so the best place to collect profits is up here. You're talking, let's say if I entered this trade here, I go up here and I made, okay, 60 pips based off where my entry was, compared to 316 pips potentially to where price can go. This is why I'm asking about channels, because if you can channelize a price within a certain high and a low, then that greatly can it can basically show you where your targets are at ultimately, your high level targets.
What happens if price doesn't want to go to the price where you're forecasting?
Then that's when we need to use profit taking to actually get in and out, and not, not keep everything on the line with hopes that it can go all the way up here, but take profits in and out as price continues to move up and down accordingly, like we normally do, trailing stops up and whatnot, so that way, we can take profits and get out of the trade as we need to, but knowing that where the price can go, you can continue to make money in and out through the up swings and low swings all the way up until this level here.
Okay, and I'll say I'll take the same scenario what you basically stated, right? Now the price is reaching to a level of supply, and you're saying, well, from here to here, from my point of entry to where I'm at now is 30 odd something pips, but the best one is up there on where where the circle is.
Mm-hmm.
But what if the price doesn't want to go beyond the last high?
It doesn't have to.
Oh, but the question, what if it doesn't want to because the market chooses not to? What are you going to do then?
You need to collect profits as you go, though. I'm not saying
Agreed.
hold price. I'm not saying hold it all the way up until this level, because you're right, it might not go there.
Correct.
But if I can go to the next level of supply and maybe scale out 2/3 of the trade and leave 1/3 ride, and then continue to do that, buy in and get out as price continues to move up and down, is that okay to do until it does get up here? If it does get up here, if not,
Perfect.
then
Okay. All right. Awesome. Okay, let's go through that. Okay, you should be able to see my screen right now. So like I said, in terms of the dojo, channels, they're very, very simple. There's nothing complex. It's nothing new. It's not really advanced strategy. But simply, well, it's advanced to the person who knows, but for a beginner, they definitely wouldn't know. Okay, now, part of that, now that you know that since an uptrend is a series of higher highs and higher lows, you're connecting the higher lows and you're connecting basically the higher highs within the trend. However, in order to draw a line or to put everything all together, not single price will actually be specific in terms of where the price is going or where the price is going to be based on the trend line. It's just a guideline, and that's one thing that you need to remember is simply a guideline of where price is going to be, not specifically where the price is going to be. So say, for example, there's one area right here, part of the consolidation. It went below it and went above it. Here's the low, but if we now draw the actual trend itself, then it wouldn't be as clear, because if I connect now from here to here, then you have a big empty space from this point.
right.
So that being said, to draw channels is merely putting as many higher lows as much as you can. The rule is simply minimum of 2. 1, 2. So minimum 3. So after a price has been detected or been tested, so say for example they didn't exist and you're currently within that area, then you will see it approximately that the price could go somewhere here, and even it could even go below it if it wants to. Alright. So you notice how the price didn't even touch to that line, tested, came back down, went below, and then went back up. So trends in terms of supply and demand, price points will drop down to a level of demand within a certain time. and part of that is simply price will need to be retested sometime in the future. If it gets tested more than 2 or 3 times, then the probability that it could break out to the downside even further on the 3rd or 4th try is highly probable based on statistical data, based on price. Can it happen all the time? No, not really. But in this particular case, if you notice here, part of your consolidation from here, here. So there's that empty space from this point. Okay, similar to the upside of the highs. If we're just connecting all the actual highs to be objective, then it won't be clear as much. Yeah, price can touch it approximately to where it is, and then it can rebound to the downside. So simply, they're like your railroad tracks. I just simply call channels are your tracks to determine where they're going to be. But of course, in between two is they will create equilibrium price points, either 50% or 62%. So if we go from top to bottom, in this particular case, notice how 38, 50, 62. If I go from top to bottom from here, same thing, they will come back down 38, 50, 62%. And it chooses to rebound from top to bottom. If it comes back to the way to the downside, notice how about 38%, 50%, 62%. Likewise from here to here, everything will fall into place. There's 62%. See, the 38 is a 62 on this side. Yep. Similar to this point, they go 38, 50, 62%, and then going back down to here. So most cases when it comes to equilibrium errors, not just on the 50% level, high and low, bam, bam. 62% is the majority. So from this particular case, then if this one will break in the 62%, then price will be retesting to bullish bar the probability of this breaking. Excuse me. Price breaking is highly probable to touch around this level before it can go to that 106 on where we want it to be. Okay, if we're just following those simple rules, so 38.2, so you have a big bummer, it doesn't go diagonally. But these 2 points with this shaded, this 2 area, is simply between the 38 and the 62% creates your equilibrium error from the supply and the demand, demand and supply error on an uptrend. Same holds true to the downside on the downtrend when it forms in a channeling motion. I believe the reason why you want to know about this is because you're an options trader. Option traders love channels. When I used to trade options, I loved channels, and the reason is you actually can make it. It's a no-brainer method when it comes to the options world. As long as you can predetermine, you can define where the highs and the lows. As long as you don't get exercised, then you're going to receive a premium. Especially when it comes to covered calls in a channeling type of environment. It's an awesome strategy. Citigroup did that for a long time, even before it broke the $5 mark, or now because now it's on the $50 mark. Before it broke the $50, as long as it doesn't reach $50, I won't get exercised, right? And then you can roll it over and over again. So, since we are directional traders, or in my perspective, we are trend followers, it is so easy just to find that if it creates a low, there's a high, there's a low, there's a high, there's a low, there's a high, there's a low, there's a high. In between are simply your equilibrium based on your retracements. That's it, pretty much. There's really nothing to overanalyze. That's how you pretty much do it in basic economics. Once there's a demand, there's a supply, there's always going to be an equilibrium based on your retracement levels. Question, Jason?
Um, but you say it's like it's not really exact. It's just it's a ballpark figure of where price is moving, but it looks pretty accurate when you draw it there, right? I mean, even if you drew it on the second high, um, like basically from left to right where your second green box is at,
Hmm.
even if you drew it right there, I mean, it still tested that and then failed and came back down to the lower channel line, right? So it's pretty accurate. Wouldn't you say overall? Yeah, there's equilibriums in between,
Hmm.
and prices kind of also retrace those levels or close to based off of your Fibonacci levels that you've drawn there. So that's, to me, it's kind of significant because, I mean, if you know where that price is moving to on the lower end of the channel, you can develop a strategy, I mean, whether it's options or Forex or futures, that is pretty valid. I mean, yeah, it pushed down below the channel a couple times, but then it came back up, and it's just part of the trend, right? And then so now we're talking about, I don't want to get too complicated, but you're going into Elliott wave theory now based on how long the trend's going to last, and then, and then you can go into the law of angles and all that stuff, and it just, you can go from there and get as complicated as you want. But as far as the channel goes, it's pretty valid from what I'm seeing here, from what you've drawn on your screen.
Hmm. Yeah, well, like every wave theory, that all comes down to a law of harmonic vibration. It's
Right.
simply part of each and every trend has certain wavelengths in between too, right? So in this perspective, you can see different frequency in between. But if you take all the noise out and you just simply draw from what you were dictating before, each and every currency pair or each asset or every vehicle, each asset class will have a sort of a pattern, similar to the chaos theory where the universe goes in random and is very chaotic, but at one point in time they go through a certain a pattern, right? And human beings are also the same. The universe is also the same. They have to go in certain patterns within that. So in this particular case, 224, 240, 214 though from here, but it's currently expanding to a certain point, to a certain degree. But if I'm just putting
Correct.
around this level, see here, 212, 220, 200, this is 300 from here to here, because they're just pretty much like expanding, like the universe is expanding all the time. The market can also expand. However, and you're absolutely right, you would be able, part of your planning, you would be able to dictate approximately on how much you would be able to make from point to point. Like say, especially with the big moves, 280, 240, 240. Here on the smaller moves, still 230, 260. But at least now you would be able to determine that, hey, each and every time it drops from the top to bottom, I can make on average 200 odd something pips within the distance of approximately from November all the way to January. November, December, January, 2 months. March, April, May, 2 months. Here, June all the way to July, this is pretty much 1.5 months. So now we're trying then that if it chooses to come back up, then to go through around this price point, about 107, will take approximately 2 months. So from August all the way to around September, probability that the price can go there is highly probable. Of course, you also have these midpoints here, which also relates to the supply level. So it's funny how, from supply, it's also an equilibrium from top to bottom. So in other words, once price goes through here, from the distance from there to there will be your equilibrium area, either just 38 or 62%, which is also aligned to the supply level. That being said, that by September, approximately the price of the dollar against the CAD will be around this level to retest that high in order, if it wants to break out, to create a new higher high by mid of September to go through around 107.73. So yeah, it's actually a very simple strategy. I use it quite a lot in terms of the way how I analyze my stuff to get an approximation on how much pips I would be able to make from top to bottom, especially in the trending market. It works to the downside, it works on the sideways movement. So that's your channels.
Yeah, it makes sense.
Cool. Anything else? I wonder if did I cover everything for you, Jason?
Yeah, you did, Ray.
Okay. Are you sure? Going once, twice? Anything else?
Well, there's an addition to that now after everything you just talked about, and it goes back into the law of angles, right? And so something I thought of just randomly, I don't know if I don't know if this is right or not, but basically the angle of the trend shows also the strength of the trend, correct? So like a steeper trend would show, of course, more strength to it. Kind of like how the channel widening at the end, where it currently is, widened more currently than it was historically, shows strength of the trend as well, shows momentum.
Correct.
Much.
Yes.
Well, the angle at which that trend is going up also shows momentum, but would it be safe to say that the steeper the angle that the trend is going up, like say if it's a bullish trend, the steeper that angle that that trend's going up, the more likely it is to fail as well?
Like fail to change for the trend?
Yeah, like you know how back in March, April, May, I think it was, around there, when the yens were on a very strong bull run, and they just went straight up, right?
Yes.
Well, I guess that's not really that true because they're still kind of in an uptrend. Because I was thinking that, basically the stronger the trend to the upside is, the more likely it was to fail. See how steep that angle is, and you look at the U.S. CAD,
Yes.
the dollar CAD right now. It's a little bit. It's not as steep as that was.
All right. Good question. Now, once a trend has been established, once a downtrend has been broken, and then you have a trending, like it created a trend. Especially, if you say here, well, this one's way too steep. But this steepness will be mellowed out at one point in time until it creates, see, like this one right here. So from here to here, and once this has already been said, let's go through on this level. Now your channels will have to change, okay? If I go through from this to this point, okay, let me change that. Actually, I'll remove that for now. I don't want to really delete some of my stuff right there because they're... So I'll just cut that for now, okay? I will cut this across because it's just way too steep. Okay. Let's say then around this, around this level for now. Should I really make it nice and clean? Okay. Right. So say for example you're in there and see how the steepness of the angle of the trend is just way too steep, breaking out and then filling that in, right? So once a trend has been established and it's going through a certain angle, you will be able to expect that when that happens too, you will be able to calculate on how fast the momentum is going to continue to create a new high, right? So in other words, if I go through, so basically from the last low, last high, that's approximately 300, 400 or something pips, 368, and notice how the steepness continues all the way there, so 360. So on average, you can make about 360 out something pips to the upside. And for counter trading, as a swing trading type of strategy, you would also be able to dictate on how far it can drop. Say let's say 100 and that's 200 pips. This one is 170. This one is 170, but it didn't, 140, but he didn't want to touch it. So from here, you will be able to chop it. That okay, great. Here it created about 100 and something pips, 130 pips. Then if you counter trend, I can approximately make about 120 pips to the downside as well. Here's just mainly a bonus to go through above more than 130 add something pips. And if you're counter trading, you cannot leave your trade more than that, right? Because your channels are simple, like I said, you're like like a railway line. These are your wheels on where they're supposed to be going. Here went over it obviously, and then came back, and notice how it is going through. So if it chooses to drop, you will know approximately the price can come back down to. Right, let's see, there it is. So you can know approximately where it can drop, approximately how much. This is similar an anomaly. And then here now, clear breakout of that steepness of the trend. And then your higher lows, these, the lows and the highs are my leading indicators in terms of the markets. So from this point in time, this is where now you can create. So from that low, we'll create specifically approximately on where the price is going to be. And now the change of the angle will now change. At the very beginning, this is the angle. Now you have a much wider channel on where the price can go. See, touching almost through there. Then if it chooses to come back, this midpoint is now your equilibrium. If it breaks through, then the price can go all the way to about the 93. Bingo. Bam. Then if it's choosing higher low, then the next price should be around there. Bam.
So it tested it, right?
Correct. They have to test certain demand levels, 1, 2, then they have to test certain supply levels until it will continue to create or to continue the channel from there to there. So we would be able to expect to come back over to 94.76 all the way down there, right? 95. Then we will be able to expect the price to come through there if it chooses to. Yes, it did. Then we'll expect for the price to come back around here. If it breaks to there, then the next run is about the 98 once again. Boom.
Now it
Clearing.
broke the channel, right?
Bingo. And it tried to come back within the channel. Now we are in a new change. In actual fact, it is now, since the channel doesn't exist anymore, it is now channeling basically in a sideways movement. So in other words, it is from this point, then easy the price can come back all the way there until they will create new type of trend once again.
Right. So could you technically draw another channel from where it is right now, from where it broke out of that last channel?
So now basically, let's say, okay, if I'm hearing you correctly, if it's going to be through that, and now if I take through here, actually it's best to use freehand.
Oh, I see.
Now if it chooses to, then this is where the direction is going to be. At the same time, you also have a small channel. See
Right.
here. So if it doesn't want to go through there, then it's going to come back through here, then come back there, here. Or if we retest, this is now the first, equilibrium second, equilibrium. It can retest through that, but if it doesn't want to, it will test through here and then break out then the next price is pretty much around this level of demand, right, around this point, to go through
Gotcha.
and retest this broken line right here. Okay. Hence uptrend, you're now in a downtrend.
Correct.
But obviously those will change if you're looking into multiple time frame. So from my own perspective, here's just one part of your wave correction continuation. Then you would be
Right.
able to create through there that once you have a confirmation of your higher low, then you will see a nice steep trend. Then you will be able to detect once again where your next profit target is going to be based on a bigger time frame.
Correct.
So yeah, you're slicing based on time frames from you're going on a daily, because if you're now more of a short-term trader, then this is what you need.
Right.
But there's a big but. You cannot go against a bigger time frame still.
Correct.
Okay. Yeah, so it's just another extra tool within your trading arena in terms of your tool belt to be able to use. So, and funny enough, look at this. What we drew on a smaller time frame is simply your highs and lows of your bigger time frame.
Mm-hmm.
Nothing more, nothing less. That's pretty much what it basically dictates. Right? You will be able to determine the size of the highs and the lows determines the trend or determines the channel between the high. It's simply a range, really, if you're really thinking about it on a bigger time frame.
Mm-hmm.
You magnify that in a small time frame, then that creates your channel, and in between are your equilibrium or your corrections. So if you really think about it, if you're analyzing in a big time frame, you will determine approximately on how much profitability you can make within that 1 month.
Right.
Yeah.
Yeah, that's kind of what I was looking for. Okay. Awesome.
Sweet.
Thank you, Ray.
No worries. Any questions, Anne or John?
No questions. Quite clear for me. Thank you.
Cool.
No questions right now. I'd probably want to go over it in the dojo, though, more of the channeling and stuff, just to get a better understanding of it.
All right, not a problem. All right, what else do you guys want to talk about today aside from the channels? Oh, wow, nothing?
Yeah, nothing from me.
I put my 2 cents already in.
Okay, all right, then if there's nothing, then my turn. What current trades do you have at the moment? I know, Jason, you have the dollar CAD. Okay, we'll go for first of the dollar CAD and see what you guys think of it.
I've got pound dollar short,
Okay, pound dollar short.
and I've got the euro pound long.
All right, how about you, John?
I had pound dollar short, but it was a day trade, so it's already out, already profited.
Mm-hmm.
And I had the pound yen, but it got stopped out, so I'm out of that one.
Okay,
And that
that's
was also a day trade too.
okay.
That's kind of maybe I guess that's one I could talk about.
Mhm.
My intent was different than what you put out for the alert. Yours was a swing trade that, on the daily chart, and I was just working off of the 4-hour
Mhm.
for shorter profits, and they got stopped out, and it touched on something that like I wanted to go over tomorrow, and that is just reducing losses through reducing your risk. And I'm not really too sure if I'm using my risk properly on the day trades, with regards to like where stops should be and whatnot. And because when you place your stops for your longer term trades, they're wider,
Mhm.
Obviously you can't use the same stops for a day trade. That's your risk to reward would be huge.
Absolutely.
Your risk to reward would be huge. So I was using what I think was a more appropriate stop, but when it stopped out, it was still, um, you know, I guess it couldn't have been any tighter. Um, so so I'm just trying to reconcile that and understand what I can do to reduce the risks. I know there's going to be losses. That's obvious. You know, the market's going to take you and stuff, and there's nothing you can do about it. But you know, to increase your profit is in one way is to reduce your risk or reduce your losses. Um, so it's something that I'm seeing enough to where either I'm breaking even all the time or I'm seeing greater losses than profit. Um, and so it's even more clear now to me because I have enough profit, but then when I have more losses than profit, well then of course it's not profit anymore. So then it only makes sense that all I'd have to do is reduce my losses and then I'd have all these profits, right?
Okay, so there are different variables. Okay, I'm going to ask you guys a question within the room. What is the secret to trading your style of trading? In other words, like, what kind or what type of trader that you are. Firstly, how do we define that?
Based on your time frame.
Okay, time frame. So what is multiple time frame analysis? Let's start from you, John. What is your understanding of multiple time frame analysis?
It's an analysis of all the time frames respective to the one that you're actually going to use. So your greater time frame relative to the time frame that you're actually trading on, and then your lower time frames to analyze your entry and maybe a little more detail on how the price action is moving.
Okay, cool. Jason?
Yeah, more of the same. Basically identifying the type of trader you are and analyzing the charts from the greater chart to the lower chart based off of whether you're a position, swing, day, momentum, scalper.
Okay, and?
Yeah, it's same as what Jason said. So if I'm predominantly a swing trader, so I look at the weekly chart at the start of the week or end of the week, and then look at the daily chart, and then trade off the daily, go off the 4-hour, and then the 1 hour for the best price.
Okay, what does multiple time frame? My next question now is what does multiple time frame give us? Let's start from you, John.
It gives you an idea of direction and strength. It gives you the capability to look at like the 30,000 foot view all the way down to on the ground.
Okay, awesome. Thank you. Jason.
Since we're directional traders, it gives us direction as well as time to be in trades.
Okay, great. And then?
It shows the trend and who's in control, and the higher time frames, and then it also snowballs down to the lower time frames.
Great, perfect. I mean, you guys got it. Obviously, you're doing an awesome job when it comes to learning how to trade. That's the number one answer, is giving the direction of the trade. Okay, let's go through and have a look at the pound against the yen. All right, we can see here what did the pound against the yen do within that moment.
Created a spinning top.
Stabilization.
Spinning top, stabilization. Okay. Is it a level of demand or supply?
Supply.
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 Level of supply. Okay, great. if it's in a level supply and if we choose to sell, where will we put our stop? Which price point will you be putting your stop? Start from you, Ann.
The last swing high.
Okay, last swing high. Jason
Yeah, I agree. 154.
and John.
Yeah, I agree.
Alrighty.
I mean, not right on it, but you would put it,
Okay.
whatever your method of choosing the gap above it.
Okay, so that high will be the last one. Why do we need to choose that high?
Because there's a visible pivot to the downside with yesterday's candle.
Okay, Jason.
It's based off your risk allocation.
Okay, rate based on risk allocation. John.
It's resistance. It's institutional resistance, and so the probability of it being broken is less as opposed to price action moving downward.
Cool. So you're the right out of the whole three. That's the right answer. What's that game? Family Feud, right? The best answer. So the best answer is that based on the institutional price point of a resistance price, right? Now there's an area of a supply between 153.56 and 154.03. Okay, we have those highs as well. But since we are in a stabilization mode and a lot of spinning tops, are there any guarantees that the price can easily drop to the downside?
No.
Nothing
No.
as yet, right? Okay, let's go through in terms of the 4 hours. Because, I mean, since the future doesn't exist as yet, price can go around this level, right? It can retest the last high. It can retest that high right there. It can also retest this high over here. So in other words, you have the first level of resistance prior to the big one right there is this small little mini supply over there before it can go through and retest through that. Okay, with the biggest high on that. Okay, if we choose to short currently right now where it's now at, for example, 152.35, 153.56, that's 120 pips stop loss, plus or minus the spread, or extra another 10 or 15 pips above it. That's quite a lot. So the question we need to ask if we're going to day trade it is, if the price chooses to come back up to these levels there, and especially within that high, are we going to be happy with that? If we say yes, then with a small position size, then go for it. But if we don't, easy logical explanation, we don't do it. What will be the best trading plan? So if the price is currently here at 152.30, what will be the best case scenario of selling if we choose to short it?
Going at the retracement, if it retraces.
Going with the retracement, going when the price reaches a little bit more if it chooses to go within the supply level. Okay.
Yeah, I would go in on the 1 hour.
Right. So we'll go through and now look into the 4-hour chart. Obviously on the 4-hour chart, that was your best case scenario of actually selling. Okay, what time did the market close at? 5 o'clock. What time is this at the moment? We are at 1 o'clock, so it is Eastern Standard Time. And the 20th, 1500 here. That's 17. It's 21, so 1700. This is where price started. Price is at a level of demand or supply.
Demand.
Level of demand. If we're going to short a level demand in an uptrend, so because we still have a series of higher highs, series of higher lows. Here though, we have a lower low, lower low, lower low, higher low, higher high. So overall, it's still pretty much in an uptrend. If we are selling at a level of demand in an uptrend, based on risk and probability, what happens to our trades?
No, I can attest that it's not going to go well.
Yeah, risk is going up big time.
Exactly. So the risk is going to be huge. Probability is going to decrease. Is it going to be a good idea to sell? Or is it a better idea to buy? Or is it a better idea that if our intention is to sell anyway, is to wait for the price to come around here and then short once there's a confirmation that it's time to short? So which strategy will you create? Start from you, John.
Wait till it gets up in an area of supply and then short it.
Okay, cool. Jason?
Well, since I'm a swing trader, I'd go long that until it gets to the next level of supply and short it.
Okay, and?
I'll wait till it goes to level supply and then short it.
Alright, cool. So we have different strategies in terms of going in, right? Alright, now we go through the 1 hour chart. This is 1500 when basically 2 o'clock our time. So if the plan is to day trade, now see, this is the beauty about the human mind, because our focus or his intention is basically to short on a bigger perspective. And then you put through a big microscope to go from a, hovering above the ceiling and all the way down to the floor, where you're now looking at the floor. It changes the whole perspective, right? Being an eagle, all of a sudden you got your prey. So, in other words, that if you're going to go to the smaller time frame, since the bigger time frame is still pretty much in an uptrend, and since you're a supply and demand trader and you're a trend trader, so when you're day trading it, if it's in a level of demand on a bigger time frame of a trend, especially in an uptrending market, or in this particular case, the pound against yen is an uptrend, your risk is smaller if you choose to buy at a level of demand and you choose to go long because you're with the direction. So hence, remember, based on MTFA, we've analyzed it well. The bulls are currently in control. Yes, it is reaching in a level of supply at this point on a bigger scale. But at this point in time, what is the price doing? It is simply in a level of demand, and it has to correct itself to retest a supply level before it will choose or decide to drop, bam, to the downside. So that's why if you notice sometimes when I put in trade alert, I put it either at market or I put in a particular specific price on the level of supply. If it goes through there, great, but if it doesn't want to, then at market price is a good enough reason. But if I choose to short, the closing price and it's a level of demand, then now that my intention is for the bigger time frame, and now my stop is going to be within the bigger stop of the trend. So as a day trader, if you're day trading, if you're shorting and your stop is way too big, then they won't take you. Yeah, but it will take time in order for your price to get to where you want it to be. Why? Because
it's not day trading anymore.
Exactly, because it is now, the price is not ready to drop as yet. The price is ready sometime in the future after another retest, and when there's some form of news to dictate that the price is going to be weak, to break it, and then you will get your price point, which is no longer be a day trading environment. It's going to be now more of a swing trading environment, an overnight trade even. So, the key is this: if you choose to day trade and you're looking into it and you're doing multiple time frame analysis, then firstly you need to check, is it a level demand or supply? If it's in low demand, what is the direction of the bigger time frame? Oh, it's an uptrend. Who are currently in control? Well, it's a spinning top. However, the direction is still an uptrend. Level of demand, bingo, you buy. Your risk is small, your probability of winning is still pretty high, even if the price is already approaching a level of supply, because what you're trying to achieve is only within this portion. Because in a small time frame, you can see very clearly these are your demand levels, these are your supply levels. So in other words, the market can only give you this much. 50 pips though in the pound is a good amount of money. From here to here, between 50, 60 and something pips, that's no worries. It's a pretty good amount, right? So just imagine if you are your intention is just to make 30 pips, 40 pips within an environment that's giving you 60 pips. You multiply that by 10 normal standard lots, 5, then you made pretty much your money for the day. So that's how day traders would be able to do, when they trade, is simply within small movements from here to here, right? Because they can determine which the supply, they can determine which the demands or demand levels are. So in that essence, they approximately know on how much they can make money. 42 pips. I've even seen a trading system, they're saying, well, 3 pips a day. Yeah, 3 pips a day, but they put like 30 standard contracts in there. So what if the person doesn't have the capital in order to put 30 pips a day? What sort of trading system is that? Yeah, if you have a 500 to 1 and you have a $5,000 account, 3 pips a day is highly achievable, no problem. Okay, but if you have a 50 to 1 leverage, can we put 30 normal standard lots on the $5,000, $10,000 account? I don't think so. Fat chance. Yeah, fat chance. So that being said, here we have a much better clear view. 3 minutes to midnight. The high didn't want to go through there. We have a better chance of winning that if we short this pair right now at this particular price point, then we have a better chance of winning to go to the downside. Why? Because from here to here is dictating a downtrend. From there to there is dictating a lower high. Lower high. So the probability that it could drop is highly probable to get to the price where we want it to be, probably 151, right? If we go through a much bigger time frame. Any questions? Does it make sense, John?
Yeah. Hey, Ray. So were you in this example? Were you trading off the? Were you doing it like you were trading off the 1 hour or the 4 hour?
If you're day trading, your king, if you say we're playing chess, is your daily chart. So another technique is this. So you take the current bar. You determine the high and the low. High is 153.10, the low is 151.72. So that range within that day is approximately how many pips? 66, 72, 4, 9, 94 pips, right? Is that correct? Yeah, 94 pips. So if we take that, oh, no, I'm wrong. Oh no, okay, just one tick. 153.10, sorry, 153.10, 151.72. Okay, let me use my new calculator. Has big buttons in there. Cool, just bear with me. Dun, dun, dun. 153.10 minus 153.10, 151.72. 151.72 equals, yeah, 138 indeed. Now we have two price points. 153, I'll take that high, I'll take that low. Okay, let me actually change that. We'll put a different color just to see it. And then that high, change the color as well, make it purple. See, yeah, it doesn't really. Yellow. Okay, here we go. Change that to yellow. Okay, and then you go through your 4-hour chart and you will dictate, see, within the range from the top to bottom. Middle is your equilibrium. Right, you go through the 1-hour chart. So that's from the high to the low. And then price points will retest it, or, as if you're in the high, this is part of the extremities. So if you, after 1 or 2, you would be able to see in terms of price on where they're currently holding. So if you go through here, I'll just put through around this consolidation here, and then you can see on this price point you have a consolidation around this level. Okay, so you have two big points through there from a supply and a demand. Here is pretty much simply your equilibrium. From equilibrium and demand, in between is your filler, is also another equilibrium. First demand, first supply, second supply, but that is just the major supply between the high and the low. This is simply just your correction. So if you know how, if you see that the price, well, it's already created a lower low and a lower high, then if it chooses to retrace, then it is simply so easy to determine that. Is it interesting that this filler in between your equilibrium and demand is your magic threes, 38, 50, and 62%. So it's just hovering within those levels. So since the direction is fully within a trending market to the upside, to buy in a level demand and on a trending market is actually easier. It's not just easier, your probability of winning is really, really high. The risk of losing is pretty small in a day trading environment. On a downtrending market, overall market, and you're day trading, you short that bastard, you will make money. Day traders have a rule. You buy at the very end. You don't do anything in between. You come in pretty much an hour prior to closing, or even half an hour prior to closing, you will make money. So 7 to 8 out of 10, you will make money in an uptrending market. On a downtrend market, if you're shorting on a day trading environment, you will make money if you're just simply just shorting within the day. So in other words, that if it's in an uptrend, even if you can see it's in a downtrending market, no problem. If you're buying a level demand, sell at a first supply or equilibrium or whatnot, you will make money. So in this particular case, if you're day trading it, you've made one direction, two directions, three in between, probably 4, 5, 6, 7. You have now clear breakout in the supply. You're just going to sell this, comes back to here. That's 1 or 2 or 3 in order for you to make money to the downside. Cool. Questions, John?
Yeah, when you say an hour to the closing, you're talking about the daily?
Yes. So if
so working off you're trading off the hourly, right? I mean, in this case, you're trading off the hourly, not the 4 hourly, and you're the daily is the king. Okay, so you set your range based off
Yes.
the daily candle, right?
Mhm.
And you're talking about so the trading time for a day trader is in the last like between 1300 and 1400. Is
No,
the
no, no,
standard
no.
time?
I'm sorry. To make myself clear. In the equities market, from 9:30 to 4 o'clock, if you buy, the first hour of trading, say 9:45, 10 o'clock, and then you leave your trade, you don't do anything in between, you come back prior to the closing, 7 to 8 out of 10 times you will make money. Now, what I'm trying to say here too is simply that here's the opening price from top to bottom. Go, this is over 300, sorry, that's the 20th. Where is 1500? 1700. Here, sorry, 1700. So but the price basically closed. Currently in a retracement correction area. So if you are buying based on the 1 hourly, because of the bigger time frame, you can see the whole trend. If you are buying and you're using with the hourly, if you buy a level of demand, you go long, you will make money
Mm-hmm.
just by going long based on the direction. Okay. So from this point, so if you're day trading, say for example, for argument's sake, you buy it over here, you sell, made money, you short, you buy back in, you sell, clear breakout, much better, you sell, currently your level of demand, well, probably perhaps you'll be buying at this point in time, and then if it chooses to retrace, but since it's a lower high over there, then maybe perhaps the probability of it coming back down is more probable. The other challenging part when it comes to day trading is simply, well, you're there pretty much for the whole day, right? For the whole hour, because you need to see where the direction is. So the daily is the king, 4 hours your queen, 1 hour is your rook, and then you also have pretty much your 30 minutes. So if you are in an environment, say you're day trading, probably the minimum charting that you'll be using is probably the 5-minute chart, but you'll just the direction. So here's also a part of, I'm going to combine based on Jason's. This is a channel formation, right? It's channeling between 2 points. So when price is channeling between 2 points, you can make simply pretty much money from going long or going short, right? Because it's in a channel.
Mm-hmm.
You sell, you buy, you sell, clear breakout, in pretty much in the supply. Selling, buy back in. Then you have another, see if there's another clear direction. If the price will break out to the downside, then you sell, you buy back in. And if there's a clear breakout to the downside, then you keep selling, because it's a continuation of the trend now to the downside. Then you have to keep an eye on the news, what the news are going to be. These big spikes right here is simply perhaps there's some form of a news-based that happened in Japan or somewhere in Asia. So all these big spikes, well, these are London Stock Exchange basically opened, so probably the futures as well also kicked in, right? Yeah, so from a bigger time frame to a smaller time frame, you will be able to actually really see it, and then you can determine from there what you want to do. But the trick, once again, is that look at the direction of the trade, direction of the pair, buy the level demand, sell level supply. Even to a minuscule on a 1 minute chart, you can't go wrong. All right, any other questions? Nothing. Awesome. Well, we're going to apply this tomorrow at the Trader Dojo because we have the Fed meeting. Okay, this time we're going to get ready. I'm going to trade it as well. We're just basically going to be focused tomorrow at 11 o'clock our time, which is 2 p.m. when it starts to kick in. And we're just going to focus and see if we'll be able to make money either to the upside or to the downside. Sounds good. So this way, when you come to the dojo, get ready, get yourself hydrated, get a lot of rest. We're gonna focus into the game, and let's see if we will not miss the movement like what we did basically in July.
You should
Oh,
have
I'm
an
always ready.
online one.
Yeah, probably one day.
Okay. Cool.
All right, guys, you have a good one, and we'll see you tomorrow.